Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby. Today, I'm joined by Nicky Numbers himself, Nick Maggiulli, writer at one of the most popular personal finance sites around. That's ofdollarsandData.com. And most importantly, author of the brand new book just dropped yesterday, Just Keep Buying: Proven Ways to Save Money and Build Your Wealth. He's here to put some data behind some of the most common questions you have about money. Welcome to the show, sir.
Thank you for having me on, Daniel. Appreciate it.
Yeah, man. Congrats on the book release. We were chopping it up before I hit record on the insanity of the first few days after a book release. I've been there. I know how tired you are. So thank you for doing this. So because you're tired, we're going to start with a softball question. I'm going to start here. You are a metalhead. You are a guitar player. I was very proud that in your book dedication to me, you talked about our mutual love of heavy music. So if this book were a song, which song would it be and why?
I think I know this. So my favorite band's Metallica, and their first album was called Kill 'Em All. And I think it's the last track on Kill 'Em All is called Metal Militia. And why I think this book, why is Just Keep Buying Like Metal Militia? They wrote this at a time when, you know, metal was all like hair metal and glam and wearing women's clothing, all this stuff, which is like, this is not what metal is. Metal is Black Sabbath. It's like, it's about the sound. It's about the, you know, the culture and all that. And they thought it was like going in a weird direction. And so I think what this book is trying to do is trying to be this sense of truth. And like, this is what finance is really about. It's not about what people's opinions and this and that. It's more of like, here's the hard evidence about all this. And that's what I think it is. And in the song, in the chorus of Metal Militia, it says, "Through the mist and the madness, we're trying to get the message to you." And that's what I think I've been trying to do for the last 5 years, is get the message to people. Like, don't buy the dip, don't, max out your 401k. There's all these different controversial opinions I have that I'm trying to get the message to people. Like, there's a different way to build wealth, and I think this is the way. So I think if I had to give you that, that's probably the short answer. That's a short-term answer. Ideally, if this book is if it does as well as I hope it does, the song I would pick is Ecstasy of Gold, which is from The Good, Bad, and the Ugly I think it's Ennio Morricone or something. I don't want to say his name properly, but it's just, that's a timeless classic. So if this book is good, it's going to be good forever. Like, that song's going to be listened to forever. Like Metal Militia, people are going to forget it. In 20 years, no one's going to be me and a couple old people that are going to know that song, but people are still going to be listening to Ecstasy of Gold because it's a timeless classic. So if you want to listen to Ecstasy of Gold, I highly recommend. It's just the best hype song. And funny enough, Metallica plays that song before every one of their shows. They've not done it. Haven't missed it, I think, in basically their whole career. So over 30 years. So.
Wow. Okay. So my question, extremely dumb. Your answer, ridiculously good. So yes, that was a very thoughtful response, and Metal Militia, a great song. Listen to it while you read the book. So you talked about, coming to us from the midst of darkness, trying to reorient a discipline that's perhaps lost its way. And one of the things that I loved about the book was that you take a different approach than the average financial guru, right? The average personal finance guru. To me, this book is right up there with other books that I'm going to give to new investors, new savers. I Will Teach You to Be Rich, Richest Man in Babylon. Of course, my book, The Laws of Wealth. I would be lying if I said I didn't give that out to folks. But one of the things that I liked is that it's a little bit kinder, gentler. I'm not going to name names or throw anybody under the bus, but I think there's this certain brand of sort of pick yourself up by your bootstraps, figure it out, you dummy, sort of financial wellness advice that's going around. And you take a kinder, gentler approach, and you even kind of give people permission to spend a little money. How did you sort of arrive at this kinder, gentler approach to personal finance?
I just think guilting people isn't a good long-term solution. You can guilt people into doing things in the short term. I think in the long term, it doesn't work. I think there's just no evidence that it works. And I think, people it wears on you. Imagine every day having to be like, oh gosh, you have to cut another latte, or oh, I can't do this. I can't. Let's just imagine how your life, how much are you going to enjoy your one life you have if you're always in that mindset, right? Of course, money matters. To say if you're like 200 grand in debt and you have a low paying job and like, then yes, I'm sorry. Like if you're in one of these really tough situations, yeah, that's going to be kind of paralyzing for a while. And there's no, I can't sugarcoat that. But if you're someone who's like, okay, maybe you have a little bit of debt, you're getting out of debt and you're just slowly building your savings, like you don't need to beat yourself up over every little thing, right? And that's what I'm saying. I think there's people I know that are actually doing okay financially and they think they're doing terribly. And I think that's the problem. It's the relative. It's always like, well, that guy's doing so well. It's like, yeah, but that's not you though. You don't have to then beat yourself up because you're not as rich as someone else. I think that's where you start to get into these really bad places.
Yeah, no, it's really refreshing. I think a lot of the personal finance approaches out there, I would liken to something like crash dieting, where it's just this joyless, soul-sucking approach to, blitzing your way to financial freedom. And I think you really have come up with a kinder, gentler approach. I want to talk about a couple of the ideas in the book, but before I get there, you talked about in your metal militia monologue there, you talked about, we'll call them your hottest takes. What is the least conventional piece of financial advice that our readers going to find in this book? The least widely adopted, least conventional?
I think that's don't max out your 401k. I think literally every personal finance expert I know says to max out your 401k. And I'm not saying no one should do, like, there are certain cases where, yes, it makes sense. You're in a high tax state now, you're going to be a low tax state later. There's a lot of cases where it's true, but I think there's a lot of people that just do it because, that's what I was told by literally every personal finance expert says max out your 401k. So if I have to give you the least conventional, it's definitely that one. And I can break into, well, why shouldn't you, Nick? Well, because maxing out, if you max out your 401k, actually run the math on this, the tax alpha you get, basically how much more gain do I get by not getting taxed, at the end versus just, buying and holding in, let's say, a brokerage account, right? In a taxable account. And how much is that? It's about 0.7% a year, right? That's just the tax alpha. Now that assumes same investment account, same fees, everything. That's not always true because a lot of 401ks have all-in fees. The funds you might be able to have could be really terrible. Like if the funds in your account are all charging you 1%, you're actually getting negative. Like it would be better for you to not contribute above the employer match, everything above the match, and just contribute to the match and then take that extra money and put it in a brokerage account and just don't trade in and out all the time. Right. And so that's the big thing there. And there's something I'd even include in the book. I only kind of really thought about this more later. So I don't know if people know this, but for a single individual, if you have no other income, you're in retirement, no other income at current tax rates and everything, you can pull out about $44,000 a year tax-free and just capital gains. It's only capital gains. So imagine you have a $1 million brokerage account. It's paying you, let's say 4% a year in returns, and you just sell off their capital gain every year. That's 40 grand a year that you can get tax-free, zero tax. You're saying, so like there's no tax alpha then for like a Roth 401k. Like what's the point? Because I could have gotten the same thing at a zero tax rate versus paying, I would have to pay 15. Well, it's zero. So it's the same as like having a Roth, right? And then if you include your standard deduction or 50, you have a couple, now you're at 100 grand, right? You have two people now, a couple can pull out 100 grand tax-free every year, right? Think about that. That changed the calculus a lot on a Roth 401k. Now, I'm not saying that if you have a Roth 401k, you're an idiot. No, I had a Roth 401k. I now have a standard 401k. I do that. I just don't go above the match because A, I like the optionality, I like the flexibility of it. And B, the fees, I'm not sure if it's worth it for, let's say after your fees are a little high in your 401k plan, let's say it's 30 to 40 bips, 0.3 to 0.4%. Is that worth it every year to lock up your capital at 59.5? I don't know. And that's why I'm like a little skeptical of it. So long answer, but yeah.
No, it's a great answer. Well, and it tells you how personal finance really is. There's almost no absolutes. There's no just hard and fast rules. It really, I think, is a nod to the need for personalized financial advice and for people to have the appropriate knowledge to take their situation into context. That's not the only controversial statement you make in the book. I could hear my compliance department screeching when you said don't max out your 401k. But earlier in the book, you make a controversial statement that most savings advice is problematic and you suggest an alternate path. Where do you differ from the conventional wisdom with respect to savings advice?
So I think a lot of the savings advice came out of a period when incomes were more stable. And what do I mean by that? If you look at the data, come back to the 50s, whatever, the same with the nuclear American household was, the male figure worked, the female figure stayed at home, took care of the kids. You have one income, right? Mm-hmm. And so you have whatever, 12 paychecks or 24 paychecks a year for that one income for that household. That was it. Today, there's so many more women in the workforce that now there's 104 paychecks, or 48 paychecks, right? So instead of 24, you're double, 48 paychecks a year. So now the problem is incomes are more variable today than they used to be back in, the 50s and 60s and 70s. So because there's more variability to say like, hey, you need to save 20% of your income no matter what, that's not necessarily a great idea, because what happens if there's some sort of volatility in your income? And what happens if you have a side hustle, right? If you don't even have consistent income, that's another thing. A lot of people don't just have, you think, oh, everyone's got a 9 to 5 and that's not true of everyone. There's a lot of people that have income where it's relied on tips, or they're doing side projects. Maybe they don't have time, for a week to do a certain side project, so they don't get paid an extra $1,000. So if you set like, hey, a fixed savings rule around a variable flow, and it doesn't make sense to me. It's like, my philosophy is save what you can, which basically means like, find some lifestyle you're comfortable with. Obviously, don't be frivolous and just like have a bunch of, money coming out every place and not knowing what's going on. Just, have some idea what you're spending, and then just stop worrying about it so much. And then if you're like, I'm not saving enough, raise your income, find a way to raise your income. And you're saying, oh, that's easy, Nick. Obviously, well, it's not easy. It could take years. Like, for example, for 3 years, I've been writing a blog for 5 years. For 3 years, I got paid basically zero. I got nothing for 3 years. And then I had built up enough an audience to run ads. Now, I'm not saying you need to build a blog, but there's probably some skill you can do a photography business, some other thing, whatever, counseling, tutoring. There's tons of stuff you can do to make extra money. So I think it's just, especially if you take time to do it, it's worth it. So I think that's my big thing against fixed savings rules, because life isn't fixed. Life isn't a straight linear. I know we like doing these straight linear 7% a year, everything. It's obviously not realistic, but that's the thing to keep in mind.
One of my favorite stats from the book, and one of the, I think, most pernicious ideas that this stat dispels, is the stat that earners in the bottom 20% save on average 1%, and that earners in the top 20% of incomes save on average 24%. So it really is the most powerful thing you can do when setting out on a wealth building journey, is to try and rev up that engine of your personal wealth. You got to get more money coming in. I think we've blamed the victims, candidly, sometimes, for not saving enough. You can only squeeze that stone so far if you just aren't making much money. The best thing you can do, learn a new skill, get more education, whatever it takes for you to rev up that engine of your wealth creation. People spend, I think, far too much time worrying about trying to wring, 50 basis points of alpha out of the market when they could be creating a side hustle, maximizing their income.
Yeah. I mean, and I also think like that 50 basis points can be a lot. If you're like managing billions of dollars, that 50 basis points is everything. But guess what? You and I are not managing billions of dollars. So, let's say even you had $1 million, 1%, that's 10 grand. So let's say half of that, 50 basis points, $5,000. Don't get me wrong, $5,000. I'm not saying $5,000 is no money, but you could spend all year to get, and remember that $1 million portfolio is a significant amount, right? So imagine you don't have $1 million, like I have $100,000 portfolio. Okay. Now let's take remember 50 bips on $1 million is 5,000. So 50 bips on 100,000 is $500. Like, do you think you can't earn an extra $500 in all the time you spend doing stock research? That's absurd, right? I know people can earn $500 in a year easily. Like any person could probably earn an extra $500 if they want to, right? So to think like someone's, I got $100,000, I'm going to get that extra, that extra 1% or something. It's like, it's just not going to move the needle. And so people aren't just, you do the math on it. Unless you have $10 million, then it's going to matter that extra 50 bips. But if you don't, it's not going to matter.
So, when I have dinner here in a couple of hours, I'm going to tell my kids this story that I picked up in your book. And you tell within the story of the Vanderbilt family who amassed a fortune of $5 billion in today's dollars. But, a few years back, 1973, when 120 Vanderbilt descendants got together, there was not a single millionaire among them. That is shocking. Right. Mm-hmm. So we know from behavioral science about this hedonic treadmill. We know about this tendency for our consumption to rise right alongside our earnings, leaves us no better off just with better taste and a better lifestyle. So I think we'd both concede that a little bit of lifestyle creep is inevitable and perhaps even desirable. But what I loved about the book is you actually put a number on it. You put some data behind it and said, look, this is how much lifestyle creep you can afford. How should we think about lifestyle creep from a data-driven perspective?
So the simulation I do to kind of run at this is, imagine someone who's like, saving money. They're kind of on a decent financial path, right? If you're deep in debt and you just can't save money, this is not going to apply to you. This is only applying to people. You're in a decent financial state. You're kind of on some path to the future, to your retirement. Everything's good. I'm not saying you have to be super rich. None of that's needed. Just you're on a decent path, right? Yeah. And the question is, what do you do when you get what I'll call a positive shock? That's what they call it in economics. But in this case, it's a big raise or a big bonus. And the question is, well, how much of that can I save and how much of that can I spend, going forward, right? Let's just say you got a raise. So it's an ongoing flow. It's not just a one-off bonus, right? And in this case, like, you're getting this ongoing raise. Now your income, let's say 5% higher for the rest of your life, let's say, or for the rest of your working years. How much of that can you spend and save? And I run this little simulation where I say, okay, try different savings rates and what's the number that gets you so you can retire at the same time, right? Because if, let's say you save, I make one assumption. We need to assume you want to have the same consumption over time. You want to live the same lifestyle. So you can get a raise and then live better, but then, retire at the same time, but then you have to cut your lifestyle down a lot. And I don't want you to do that, right? So let's assume that's not going to happen. So let's say you have the same lifestyle over time. Then what I find is, the numbers congregate around a 50%, call this a marginal savings rate, or a 50%. That's how much your raise you need to save, about half of it. So basically, for most people who are, saving in some ballpark area, let's say, 0 to 30%, if you get a raise, you need to save about half of it. And the other half you can spend, which is cool. And I'm saying, hey, there is some lifestyle creep you can have and you don't have to worry about it. So I'm trying to get at that, like, hey, there is some optimal amount to go for. And I think these numbers can be backed by, you can run a simulation and show, hey, they're on this path, they're doing this, and then, they get this positive shock. And then, okay, how do they make sure they retire at the exact same moment as before? They have to save half and they spend the other half. And so that means you can increase your consumption, have that increased consumption the rest of your life and into your retirement, and you retire at the same time. So you kind of preserve everything, yet you're still allowed to, have a little bit of lifestyle creep. And I think that's rewarding and enjoyable. And people should enjoy working hard for a raise and say, you know what, I'm going to go out an extra one night a week, with my wife and kids or something. We're going to go out to a nice dinner once a week. And that's something we couldn't do before. And I think that's fair.
I think that's a perfect example of how you walk a really sound line between, being a sound financial decision maker and just getting, enjoying life. I often hear the advice, like, act like this raise never happened. And I swear to you, if I tried to live like I lived, 15 years ago, I'd be miserable. It'd be all hot pockets and misery. Like, I want to, I've done well. I want to live it up a little bit. But trying to find the right line is important. And I think you do that well. Reading this book when I did, one of the things that stuck out to me, you talk about there's a number of reasons why investing is more important now than ever. You give inflation as one of these reasons. So I'd be interested in hearing from you why else you think investing it matters now more than ever. You give these examples of how quickly inflation can erode purchasing power. We've got CPI at 8.5%, PPI at 11 and some odd percent. And we've got a market that has been, trading sideways to down for a couple of months now. How do people think about investing during a time of inflation that's rising this dramatically when the market's also not keeping pace?
Yeah. So I think the main thing to think about here is, like, inflation has obviously gone up over the last year. And generally, if you look, and this analysis wasn't done in the book, but I've done this analysis, basically when inflation's above 7%, like, the returns over the next year, like in the US stock market, are lower than if it was below 7%. So I think the number is something like, when it's above 7%, the next 1 year return is like 7.3% compared to when it's below 7%, when inflation's lower, it's like 10.3%. So there is a difference there. So we should expect, all else equal, we should expect, the future stock returns for the next year to be a bit lower because of inflation. Inflation is not great for stocks. They're still like probably the best option out there. But you're like, okay, maybe I'll just move to bonds, right? Maybe that's my solution, right? But if you move to bonds, you look at what's the real, return on, like, let's say 5-year treasuries, for the next year, and it's negative. It's a negative real. That's the median outcome, is a negative real return over the next year when inflation's high. So inflation hurts stocks a little, but it really hurts bonds. So, there's nothing really you can do. We're just in a bad spot, and you kind of just got to live through it. You got to kind of make way. And I wish I'd be like, oh, there's gonna be high inflation. What do I do? Do I buy this? Do I buy that? Like, you can try things like, okay, I bonds are good. And then so you can try I bonds. I have a personal funny story about I bonds. I tried to like sign up for I bonds and they didn't my identity wasn't verified right away. So I had to do this like special step where I have to get a stamp from a bank and my bank, I only have one bank I'm at, and they won't give me the stamp. So I'm like, I just can't get I bonds. So that's out for me. So you only put 10 grand in a year anyways. So I'm like, okay, I bonds are gone for me. So not going to deal with that anymore. But basically it's just like, you don't have many options and you just kind of got to roll with it. And sometimes that's how the world is. I'm sorry. You're like, oh, Nick, you're supposed to have a solution for everything. Like sometimes there's not much you can do. Like maybe you got to be flexible on how you spend money or flexible on like, okay, what things do you really care about? I mean, if it's really impacting you that badly, just think about that. So like, that's what I would say, because inflation's not great, but yeah, there's not much we can do there.
Yeah.
In the short term, at least in the short term. Yeah. Because in the long term, yeah, we were saying, yeah.
Yeah, no. I'm thinking back to the charts in your book that were jarring to me. I mean, I it's like, I know the math, but then seeing it visually was really compelling to just see how quickly inflation will eat your money. And so, yeah, I feel when friends call me for sort of informal financial advice, sometimes I feel like the bearer of bad news, because it's just like, look, there's no slam dunks, there's no sure things. Sometimes the world is just tough and there's a lot going on and not a lot of it's great, but getting your money eaten at 10% a year is not great either. So you got to take some risk.
Yeah. The one silver lining here is if you look over longer time periods, even as little as 2 years, so going from 1 year to 2 years, the return, whether above 7% or below 7% inflation, is almost identical. I think it's like 18.5% when it's above 7% inflation versus 18.7%. That's a 2-year return, not a 1-year return, by the way.
For sure.
So it's like basically like these kind of things are usually only a short-term phenomenon, at least in data going back to 1926. That's what we have. Obviously, this could be different and we don't know. And we could, wow, this is outside of history. And so that's what happens. But we'll just have to wait and see. I mean, that's all you can really do. And so I think don't make big tactical shifts to bonds. I don't think that's going to help you right now. That's the only thing I would say, because those things generally do. Debt is really bad. If you're a debt holder, it's not great in inflation, in inflationary environments.
So from my seat right now, I'm not hearing a lot of outright panic, right? I'm not hearing a lot of folks going to cash and things like that. But I am hearing a lot of folks saying, if I've got a little cash, if I have some savings that I'm sort of accruing right now, I'm going to wait for a better time to enter the market. And, the justification is we've got a war, we've got inflation, we've got COVID, coming back. For Canada just declared a 6th wave of COVID. Parts of the Northeast are going back under mask mandates. There's a lot to worry about, right? Legitimately, there's a lot to worry about. But the subtitle of one of your chapters says that not even God can beat dollar cost averaging. And I thought that was a fascinating take. Tell us more about why historically waiting for a more opportune time to enter the market hasn't been a great thing to do.
Yeah. So the long story short of it is, most equity markets across the globe throughout most periods in time have, increased over time and gone up and to the right, as they say. And so what that means is when you're going to buy a dip, let's say you can even successfully, you wait for the dip, let's say 10, 20, whatever, you pick some threshold, you wait for the dip. By the time you buy it, usually the price is higher than what you could have bought at initially, right? Mm-hmm. So that's the question, right? You take someone who buys every month, take another person who buys every month, but then they at a peak, they're like, oh my God, the market's at a peak, I'm going to stop buying. And they wait and they just hold cash. Now there's a big dip of some threshold amount that they determined beforehand. Okay, now I buy it. Usually the time when you buy it, it would have been better if you'd just been buying the whole time on the way up, right? So that's usually, and it's not intuitive at all. You'd be like, oh, these are discounts. Yeah, but if the price of a stock's 100, goes up to 200, and then it drops 20%. So 200 minus 40, that's 20%. It's 160. Like, wow, I got a deal. I got a 20% discount. Yeah, but no, you actually paid a 60% premium because you're buying at 160 instead of 100, right? So that's kind of the idea there. So it's one of those things where it's not intuitive at all, but you can do thought experiments to make it easy. Like imagine if I said to you, okay, you have $1 million, you have $100 million, make this even easier. And you have to try and, maximize its purchasing power, a century from now. Would you rather, you have two options, you either put all 100 million in today, or you have to put in $1 million a year, each year for the next 100 years. And remember, this is sitting in cash, by the way.
Right. Yeah.
Which strategy is going to make, and you're like, oh, that's obvious, Nick, like over 100 years, of course you would do that. Right.
Yeah.
So I'm like, but that truism there generalizes downwards. If you wouldn't wait, 100 years, and you shouldn't wait 100 months, and then you shouldn't wait 100 weeks, and shouldn't even wait 100 days. Right. That's the idea. So of course it's risky. And there are times where it's like, okay, well, I'm just going to wait, this is great. Well, let's say you wait, you buy the dip. Here's the second part. It's a behavioral issue. Let's say you wait right now and then a dip happens and you successfully buy a dip. You're like, wow, I'm a genius. I knew this was happening. You're going to win in the short run. I'm not going to lie. You will beat someone who's buying every month because they're buying every month. They're not moving to cash. They're not doing that. You're going to move to cash. You're going to buy the dip. You're going to be successful. You're going to be great. But guess what? That win is going to mess you up later. You win in the short run, but you're going to lose in the long run. There's tortoise and the hare here, right? You're going to be ahead and you're going to say, oh, I'm now going to go to cash now during, let's say you bought the dip in, let's say 2009, right? You're smart, you're a genius. 2010, maybe 2011, you're like, okay, I'm going back to cash. I know it's going to crash. I just know the markets we're going to a double dip recession, blah, blah, blah. Then the market rallies for the next, 8, 10 years, whatever it is, how long it's been rallying. Now that's where you lose. That's where you lose. You win the battle, you lose the war. And that's the kind of thing to think about. So I know it's scary to keep buying. And if you're like worried about doing, then you shouldn't have 100% stock portfolio. Put some into international stocks, put some into farmland, put some into find other income producing assets, right? That's diversify, own some physical art or something that's not income producing, own some crypto, whatever, find things that are like different, right? And put a little amounts in different things that are going to help you sleep at night. Like, that's what I do. I'm not 100% US stocks, my equities are only 70% of my portfolio. And then even of that, the US is whatever the market cap weight is, 55% is whatever a firm does, right? So the same thing, right? It's like, I'm not even 100%. Like I talk about the S&P 500 a lot, but it's like ends up being like 30% of my actual portfolio. So when the S&P drops, it's not like I'm taking 100% of the brunt of that fall, Obviously risk assets are correlated and they generally move together. So when the S&P drops, everything kind of drops, but in the long run, that's definitely not true.
So I know you probably started writing this book, like a year and a half ago?
Yeah, I started at the beginning of 2021.
Yeah. So you started writing this book about a year and a half ago, but so many of the chapters feel like they're just so timely. And towards the end of the book, you talk about why we shouldn't fear volatility, how to buy in a crisis. So I want you to, in your typical Nicky Numbers way, tell us what you found there and what the data says. But I also want to talk about the behavioral piece, about how we can grasp that emotionally as well as intellectually, because I find that, all of this stuff makes sense and then it's kind of out the door when we need it most. So how do you buy in a crisis? Why shouldn't we fear volatility? And then I guess, what have you done personally to get beyond the numbers and make those ideas really stick with you personally?
Yeah. So buying during a crisis, I guess I'll just kind of dig in on that one. I think the volatility argument's a little bit different, but buying during crisis, I basically came to this realization in like March 2020. Like it was literally like the day before the bottom. I was like thinking about this. I'm like, I need to write a post for the next day. I usually write on Tuesday, but I was like, the market's down so bad. Like I know people are freaking out. I was getting texts from people. What should I do? So I'm like, I'm going to release on Monday. So I actually broke my pattern and released on Monday. It was that important. And by chance, that was the day of the bottom. That's pure luck. But you can see like there's some weird, thing was happening in the market that was made me write this post. It's chapter 17, by the way, and just keep buying. So basically what I said is, okay, there's a mathematical fact we know. This is mathematics. You can't debate it. For a given percentage drop, you need a larger percentage gain to get back to even. So I'll give you a simple example. Let's say a stock's at 100, goes to 50, drops 50%. To get back to even, you don't have to go up 50%. To 50 go to 100, you have to go up 100%, right? 50 has to double, goes to go up 100% to get back to even. So that was interesting. And I said, okay, where are we now? At the time, the market had been down like 33% roughly, about a third. So, if we're using the 100 as an example, 100 went to 66. Mm-hmm. So to get back to even, it has to go up roughly in 33. So about half, 50%. It needed a 50% gain to get back to even. And then I said, okay, I ran a poll and I said, okay, we're down 33% right now. How long, I asked this of Twitter, FinTwit, I said, how long do you think it's going to take to get back to, for the market to recover, to get back to its new all-time high, basically? And I said, it's going to be less than a year. Is it going to be 1 to 2 years, 2 to 3 years, or more than 3 years, right? So I thought that was a decent, at the time, that just felt like that made sense. Those categories. And so basically, I can't remember, the median answer was like, I think 2 to 3 or something. It was like the most common answer, 2 to 3. I personally thought it was going to take 1 to 2 years, right? But from that answer, once you have that answer, and if you think it's going to take 10 years or 5, we can get to this, right? So let's say your answer is 2 years, right? So remember, we're down 33%, which means we need 50% to get back to even. If you think it's going to take 2 years to go up 50%, you can basically back out your expected return of buying right now. That's the whole idea. So this is not exactly correct, but let's just do a linear extrapolation. Technically, this is compounded math, so you wouldn't do this, but 50 divided by 2 is 25. So it's roughly 25% is what your annualized return would be to get back to even. It's actually like 23 or something if you do the math, but because they compound on each other. But the point is, like, once I have your estimate of how long you think it's going to take to recover, I can then back out your estimated return going forward. And then I could say, would you accept that return or not? So everyone is like, that wouldn't buy on March 23rd is basically saying, oh my gosh, I would not accept a return if you thought it was 2 years of 25%. And that's obviously ridiculous. Everyone would be like, I said 25%, you want 25%? Everyone say yes. There are no people that would say no. I think even Jim Simon said, you can guarantee me 25. And maybe he wouldn't say yes, but like a lot of people would say yes to 25%, right? Guaranteed, So you're like, okay, what if the market takes, 5 years? Well, okay, 50 divided by 5, that's 10%. I mean, actually compound is 8.5%. It's like, that's actually a pretty good, that's like an average market return. It's good. If I get guaranteed that, would you rather take 8% a year guaranteed, or would you rather just take the market's return? I would probably take the 8.5% guaranteed, in my opinion, right? So even on a 5-year recovery, which most people didn't think, the market still looked pretty attractive, right? So once you start doing that math, you start to realize like, wow, actually it's not as, scary to buy right now. Like the math is showing you this. So what you're talking about, the intellectual evidence is there, right? To think about this. And so once you think about it that way, like, do you think it's going to take 5 years for us to get out of COVID and recover? And I was like, no, I thought it'd take 1 to 2 years. But what really happened? 6 months later, we were at a new all-time high. So what was the annualized return? It was like 106%. It was absolutely bonkers. No one saw that coming. I'm not going to say I knew that was no way. I would remember, I thought it was going to take 1 to 2 years for this recovery. So it's very interesting to see how that happens. But that's like the intellectual side of it, just like understanding the math and thinking like, okay, once I have an estimate of how long it's take to recover, I know how far it's down, how far it needs to go back up. You can just divide that math and you have a basic, would I accept that return? Would I accept a 10% return for the next 5 years? And it's like, well, I think I would. Okay, so I should buy, right? Assuming you have cash to buy, and you shouldn't have cash, but if you do, great. So, all right, that's the whole thing. There's a difference between waiting to buy the dip and buying the dip. Like I support buying the dip, but I don't support holding cash waiting to buy the dip. They're very different, right? If you happen to come into cash, or, oh, I got paid a bonus and like I'm about to invest like a week later and then we're in a big dip, oh, buy. It's a great time to buy. Yeah. But holding cash and waiting in anticipation is silly, because big dips are rare, and big dips are especially rare, right? So that's the thing there. So behaviorally, the other thing too is like, once the market's down that much, you have to like, I guess you just have to imagine like, markets are resilient. They generally recover. And of course, you're like, well, what about Japan 1989? What about Greece 08? What about, Russia 2022? Right? What's happening right now? They went down 80% in a month. Like there are exceptions to this rule. Don't get me wrong, but like there's a lot of equity markets out there that have not been like, in other words, that's the exceptions don't disprove the rule, right? Which is most markets, most time are going up over time slowly, even at some times, but they're growing wealth generally. So that, just keep that in mind. And once you have that information, I think that's what allows you to kind of just keep buying over time. And that's the kind of the idea there. So,
but you have a gift. You have a gift for framing things in a way that I think really elicits some really good behavior. Your 100 years example, I think, is really compelling. Would you dollar cost average in $1 million a year over 100 years? Well, if you wouldn't do it over 100 years, why do it over 100 days? Very intuitive to me. And this example, same thing. I've never thought about it the same way, but how long do you think it takes us to bounce back from this? What's the expected return? That's a really simple but compelling frame that I think could elicit some great behavior in folks. So last question, this is sort of off script. I'm wondering what you changed your mind about, or what surprised you in preparing the book. Anything that kind of shocked you, surprised you, or changed your thinking?
Yeah. So when I was writing about, saving and how much money people need to save, I was kind of shocked by some of the retiree data. And so I'll give you 2 pieces of information that shocked me. The first piece I found out was, there's like this retirement crisis that's happening, right? I want to like learn a little bit more retirement. So I'm just digging. And I would say like, you're not saving enough money for retirement. There's going to be this retirement crisis where people don't have enough money and all this. I'm looking at the data, and it's like 1 in 6 or 1 in 7 retirees. Well, I can't remember the exact number now, but I think it's like 1 in 7 retirees is pulling down principal. That's it. Like selling off there. So if you have $1 million, they're actually selling the million. The rest are all just living off the investment returns, right?
Mm-hmm.
Just like, okay, it went up 5% this year. I'm just going to sell that off and keep the principal the same. I'm just going to live off the dividends basically and their social security, right? And I was shocked to hear this. I was like, what? That's it. And the people that don't have any investments, they're just living off their social security. Obviously, they don't have a choice. But most people that actually have investment accounts, most of them aren't selling down their principal. So if there's this massive, retirement crisis thing, like a lot of these people aren't selling down their assets. So it's like, how are all these retirees running out of money? Like there's just no evidence for that. Like at least in like the data. And if maybe not looking at it correctly. I mean, critique the book, go ahead. But I'm like, I've looked at this is not me. I didn't come up with the study. I'm checking the studies that are out there. And I'm just like, data is not supporting it. And the second thing, there's like more to that. It's like, well, why is this happening? Because retirees think they're running out of money when in reality, their money's probably going to keep growing. And if you look at the inheritance data, like the money that's bequested as people die, on average, it goes up with each age cohort. So in the 60s, the average, inheritance is like 300K. By someone in their 70s, it's like 340 or something. And then by the 80s, it's even higher, right? So it generally goes up over time. It does drop a little bit in the 90s, but by then, like the people in the 60s and the 90s, that could be a generational cohort effect, people who didn't invest over time. So I don't want to get into that too much, but the point is like, a lot of people think like, I'm going to run out of money in retirement. It's like, actually your wealth might just keep growing to a point where like, you don't even know how to spend it. And I think that's the problem I tend to see a lot. And so I think my most surprising fact in the whole thing was a study done by Michael Kitces that I found when I was doing this research. And basically, the study showed that you are more likely as a retiree, let's say, you have a portfolio, you're doing the 4% rule. So it doesn't matter how much money you have, as long as you're just using the 4% rule. So if you had $1 million, you'd be pulling out 40,000 a year, right? So doing the 4% rule every year, you're over the 30 years, you're more likely to have 4x your wealth by the end of the 30 years than you are to be under where you started. So if you had $1 million, you're more likely to have $4 million or more after 30 years of doing the 4% rule than you are to have under $1 million after 30 years. And that is like shocking. So there's all these people like, you're going to run out of money in retirement. It's like, no, you're probably going to build like a ton of wealth in retirement. And of course, like, how could this not be true? Well, if, US stock returns just crumble, like if they're half of their historical averages, there are ways where these things can happen where this won't be true, but like you would have to have a massive break from history that would be like unlike anything we've seen in the data. Because remember, all these studies were done across, like you're doing 1926, you're doing 1936, 1946. Didn't matter when you started, they average all that out, and it's usually true. So I think the thing to find is like, you're probably going to build more wealth as you retire, unless you're spending like crazy, and that's the shocking part. And so I think for me, it was shocking to hear like, yeah, like there's so many people that, for example, required minimum distributions. I'm assuming your audience maybe has heard some of that, where you're forced to, the government's basically like, hey, you need to take this money out so we can earn some tax revenue on it. Most RMDs, I can't remember the number now, it's in the book, but most people that take their RMDs, they don't know what to do with it. So they just reinvest it. So it's like, they're forced to sell this thing just to put it back in the market. And it's like a funny, like, you think like, oh, I need to take it because like that's why it's required, because people don't use it. Like it's the whole point. Like that's the whole. Even the law, is supporting my point, because they know people aren't spending down their assets, so they're forcing you to spend down your assets so they can get tax revenue. It's kind of funny. Like we don't think about that, but like that one thing alone is like enough to the whole idea is embedded in that. So.
Yeah, that's incredible. That portion, the four, more likely to 4x than to go dip beneath your principal. That is circled, underlined with exclamation points and stars in my book. That was shocking to me. I think we've been force-fed this narrative about a retirement crisis, and I don't mean to minimize it. I know there are legitimately some folks, even many folks in this country who really do need some support. But I feel like sometimes there's this ulterior motive around some of these financial ideas that we're fed, and it's really shocking for me to read that about the 4% rule. So Nick, the book is incredible. The highest compliment that I can give it is what I gave it in my 5-star review of it on Amazon, which is to say that I'll be giving this to new investors, new savers, people who are heading out on a journey of wealth building, to cut through the haze, to get with the numbers, and to really understand the fundamentals of building wealth. So incredibly well done. Congratulations on the release of the book. If people want to read your blog, if they want to buy the book, where can they find you?
So buying the books on Amazon, just keep buying. You can find me on Twitter. My handle's @dollarsandData, all one word, @dollarsandData. And yeah, just DM me. What I always try to answer every DM I get. I've been getting a lot, but please send them to me. I'll definitely try to answer as much as I can. And then my blogs of dollarsandata.com. If you're interested in that, I'll be blogging every Tuesday.
Yeah. And sometimes on Monday when you're presciently calling market bottoms. Nick, thank you again. Thank you again for coming on, and congrats again on the book.
Thank you. Appreciate it, Daniel.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.